Good morning, everyone. That's for everyone in the UK, in the Middle East, and good afternoon to everyone who's in Asia and joining us from Australia as well as from New Zealand. Today, we are bringing to you a very, very interesting topic, and it is company valuation. Now, this topic is very close to all the accountants' heart and mind, because is it a art, is it a science, or is it both? So to answer that, I want to hand over to Sandy Hood, who's from the UK. Sandy is an lecturer with Ultimate Access. And Ultimate Access is a company based in the UAE. We bring to you both SEMA as well as other executive courses. And my name is Andrew D'Alvis. I'm from Ultimate Access. I'm one of the directors as well as a SEMA board member. Over to you, Sandy.
How do you do, everybody? I know it's different times of the year for many of you, but the next hour we'll spend looking at company valuation. And this is the advertisement that I think Jay put up very kindly, how to value a company. And I'm going to try and help you through this. I think we start off with the question of why would we want to do it? And I think the two things, well, I've got 3 bullet points here, but there are certain keys that are very important. We might be looking at selling a business and we want to know how much to expect. I think certainly when you're making a sale, you don't want to find a few weeks later that the value that you attached to the sale was actually lower than most people would have considered would have been appropriate. So we want to make sure that we're selling the business at the right price. We may need to value the business in order to raise debt. Certainly, if we are borrowing, then we want to know how much the business is worth to start with. And very often, the business can be used as collateral or security against the debt. And similarly, if we're looking at raising equity, in other words, selling shares, then we would want to know what the business is worth from that point of view, so that we know how much effectively each new share is going to be worth. And the other reason, quite practically, is that we may well be wanting to address cash flow problems. And if we know the value of the business as an asset, then we can use that in order to have additional cash within the business. And similarly, the potential financiers or lenders or investors will need to have an idea of how much the business is worth so that they know how safe their money is. We may also be looking to add shareholders, and it's quite possible that we may be looking for more shareholders if we're looking at a buyout. So all the shares would need to be valued. Certainly within the UK, a small number of private firms feature on a television program called The Dragon's Den, where prospective investors look at the prospects of various businesses. Not quite the same way that we would, mainly because it's done for television purposes, but it gives it gives members of the general public a reasonable idea about how things are done by investors. So we need to know what the value of a company is. And I just wondered if any of you would like to sort of state it. If I put the chat box on my screen, I can see if any of you would like to volunteer a description that would tell me the value of a company. I'll let the second hand go around for another 15 seconds before I put my next slide up, just to give you a chance. I think it's very straightforward. Okay. Well, I haven't seen any responses in the chat box, and so I'll move on to this slide. Oh, market value. Oh, good, Lavina. So we're into a good start. Excellent. And Mohammed, the fair value entity. Okay. And certainly, I would say it's the net present value of all the future cash flows. And I think that's very easy to say, but is that the end? Does that mean that the class is over? Well, I'm sorry, no. What's the problem with the net present value of future cash flows? They're in the future. We don't know what these future cash flows will be. We're having to make estimates, and other people could be making different estimates. If I could fast forward the time, I could see if it's going to be worth it. So we've got to make our decision now. We don't know what the future cash flows will be, and we need to use other factors to value the business. So we are going to use approximations. I'll have a quick look back now at the various points that you were saying. The expected sum of cash flows, good. Generally, we would think of those discounted back to their present value. The fair value of the entity, which I think we could generally regard as being the same as the market value that Lavina said. I know that some of you may recognise that sometimes market values are disjointed in a way because of the way that stock markets can go up and down independent of the value of individual companies. So I'm going to try now and show you a little clip. This is one that was taken from the news this week. This is quite a hot news item, and what has happened is the company Unilever has recently taken over a company in Korea. It's only 48 seconds, so I'll just play it very quickly. I can't get the volume, no doubt, because we're broadcasting at the same time. Oh, what a shame. Okay, well, what I'll do is I'll talk over it. And what this is saying is that Unilever has recently took over a firm in Cuba last year. This is a very big company that produces lots and lots of products. But this week agreed a deal worth 2.7 billion US dollars to purchase a Korean company called Korea Carver, or Carver Korea, and in doing so they were demonstrating that they have a perceived value for that company. Let's see if we can return to it. So this is a real current issue, and certainly within the UK financial press has generated a fair amount of interest. There's been 2 or 3 transactions since last Saturday, and this was the one that that caught my eye more than the other 2. Now, fair enough, they valued a company that produces cosmetics and beauty products at $2.7 billion. How on earth have they reached that, or how on earth could we reach the valuation of a company? Well, I'm going to show you three basic methods. The first one is called an asset-based approaches, and in it we've got this idea of basically the carrying value. You total up all the investments in the business. Basically, you're adding up the assets, and as I think somebody pointed out, they're not always shown on the financial statements. But you add up everything that the business owns. If you're doing this on a going concern basis, you tend to be looking at the carrying values in the published accounts. I think, to be perfectly honest, there's very little buying and selling of businesses on that kind of a basis. But the next one is a revaluation basis using the market values. So this brings in the points that were raised within the chat box. And so the various assets of the business and the various liabilities of the business are valued at their market value. And then the net is what is the valuation. So here we have an example, a fairly basic sort of an example where we've got the statement of financial position of Sandy Inc. And here we can see the total assets come to 340 million and total equity and liabilities come to 340 million. And within the equity and liabilities, we can see that there is a bond, a non-current liability, there is a current liability, and they add up to 140. And based on that, you can see that the equity and liabilities is 200 million. Thank you. I just saw Andrew's question, whether or not you would want to invest in such a company. I suppose it all depends what the price is. And here, I've put this down as the valuation being the total assets minus the total liabilities. And here we can also see that this is equal to the equity plus the retained earnings. And I think we would cover that kind of topic with one of the more introductory units, certainly preparing for consolidated accounting when one company buys another company. But this valuation is very book-based. Now, I've modified it and I've said that, well, actually, if I was to look around, I would see that even in their current state of wear and tear, our non-current assets are actually worth 50 million more than the carrying value within the financial position. And therefore, I've increased those non-current assets, giving them a revaluation approach. And I've also recognized that within inventory and receivables, then the realistic value is 10 million less. Perhaps we've got some receivables that I can't be sure we would actually receive, or there might even be some of the inventory that if we were to take over the company, we wouldn't consider would be saleable. So we've taken 10 million off that and left the bank and the cash the same, because after all, the money that they've got and the money that we are looking at having would be identical. And then down to the bond, if we were to try and repurchase the bond, perhaps because it's got an 8% coupon value, it's probably running higher than the market value. So we've put an additional value on that of 20 million. In other words, we would have to pay 70 million if we wanted to try and buy those bonds back. So again, that's the value today, and that gives me two new figures. I've got a total assets figure of 380 and a total liabilities figure of 160. And I know some of you like to do these little sums. How much would we say on a revaluation basis Sandy Inc. is worth? I'm not sure now. What is the business? Well, oh, well done. Oh, Sano, thank you very much. I hadn't been very specific. Well done, well done. 220 million. Excellent. Oh, I'm pleased. I wasn't sure if I just wasn't explaining myself clearly. So there we have it. Good. Revaluation of assets minus the revalued liabilities gives us a valuation for the company of 220 million. Right. I'm trying to think now, could you imagine using this approach if you wanted to value a target company or value a company for sale? So it becomes, well, it looks too easy, doesn't it? I don't know whether this picture's familiar to any of you. It's taken from a film, so there's a slight element of shadow within it. The character over here that my pointer is going round and round is an actor. Is played by an actor called Richard Gere, and these are all four businessmen doing a transaction. Essentially, they've gone into the boardroom to negotiate a price that one company will buy the other company for. And the film that it's taken from is called Pretty Woman, and Richard Gere starred in the film with Julia Roberts. And what Richard Gere's role was is he ran a company that effectively bought up other companies that were undervalued, and it's called asset stripping, and that was what was going on. So under those sort of circumstances, you would value a company in terms of the breakup value of the assets, and if you found that that value was greater than the value that you had to pay by buying the shares in the company, you would buy it, break it up, and make your profit. So that would be one of those circumstances when asset values would be used in the purchase of another company. My second topic is earning value approaches. And here we go quite similar to where we started, the idea of the present value of the future cash flows. And here we're looking at the ability of a company to earn. And now the word earn and earning is sometimes needs clarification. I'm using the earning expression that's often used by American companies. And when we talk about earnings in America, then we're talking about profits, what the UK and international standards would call profit for the year or profit after tax. So here, when we're looking at the earning value approaches, it's a very common way that you take the earnings in previous years and project them into the future, and you predict what future profits are going to be, discount them back, and that gives the idea of the purchaser's willingness to pay something. Obviously, your discounting needs to be done at a particular rate, and that would be typically at the cost of capital that the purchaser would be incurring. Now, it's rather like our standard sort of approach to investment appraisal. So it's we like to do it with cash flows. In fact, accountants generally prefer cash flows to profit. But companies acquiring other companies will often value their targets using profits instead. And this word normalization, spelt with a Z, rather gives the game away that it is an American sort of approach. But the idea is that you want to take out exceptional costs or exceptional gains that a company may well have had in a particular year, so that we are projecting or extrapolating what we would call the normal profit level within the company. So this is the way in which the the acquiring company is able to look at the performance of the company they're looking to acquire and then try and project into the future. Now, exactly how they discount the future cash flows or the future profits would be variable. It would depend on how volatile the past earnings have been. Are we dealing with a company that perhaps is in the pharmaceutical area and producing life-changing drugs, which can sometimes have 3 bad years and then maybe I'll have a super duper year? Well, we would want to try and normalize that, but we would also have to recognize that that's quite a different company from another one that may well have had steady earnings growth over those 4 years. And similarly, we may well be interested in their market share. And I think that the idea of the market share and the discounting will come into our later discussions. And you certainly can. I think, Mohammed, let's be clear. When we're looking at earnings, we're looking at earnings which are based on the whole of the assets of the company. So they include the intangibles. And so that the intangible assets that the company have are used to generate the cash flows. The intangible assets that the company have are used to generate the profits and the earning. So it doesn't, there's no distinction made within that particular method whether or not your company is based on a high level of intangibles or a low level of intangibles. And sort of bringing the intangibles bit into the next slide, when we're looking at quoted companies, then the share price of a quoted company, again, is a recognition of the company's ability to generate dividends and capital growth. And again, that comes through from both the assets that it has to generate those capital growth and dividends, and from the intangible assets it has that does it. So I think that sometimes there's a danger in trying to separate the two out. The share price the investors are willing to pay, and how much the investors will use their knowledge of the company to decide on how much they think that it's worth. So earnings value from quoted companies, often a proxy company which operates in the same industry, is used. And when you do this, accountancy exams are rather contrived, but it's to try to give exam candidates a little bit of a feel for the real world. And so we would look in an accountancy exam at the risk being split, and we call part of it financial risk and part of it business risk. And so within that, the gearing is what causes the financial risk, the level of debt as a proportion of the total amount invested in the business, and the business risk is the risk that's caused by the business in which the company is operating. Now, it isn't always easy in real life, but certainly in the contrived circumstances of an accountancy exam, you're able to find what's called a proxy company. And if you are, then you remove the financial risk and basically ungear the company. And then you're able to find the risk factor that is specific to the industry itself. And we call this a beta. I think for the purpose of this class, and I know that very many of you are not accountancy students, I'll try not to bombard you with too much jargon. But we're looking at the risk inherent in the industry, and we then combine that with the level of gearing that the target company has, or the company that you're trying to sell has, and that would give us an overall idea of risk. And that would be specific to the company. So it is brought together the risk that the company endures because of the industry it's operating in, and the risk that it's got because of the level of gearing that it's got. And this risk is then used to find what we would call the cost of capital. This is the ultimate cost that the business incurs in just having the capital that it needs to run. So we combine the risk factor using the level of interest, basically, that's charged to investors who are making investments that don't have any risk, and these are generally government bonds, particularly highly secure governments are considered to offer no risk to investors, and so they tend to have very low rates of interest. And then we also apply it to what we call the premium, which is the amount that the market rate of interest exceeds the risk-free rate of interest. And this enables us to produce what we can call the cost of equity. Now, don't run away just because I put a formula up. I'm trying to keep these sort of accountancy student type things quite low key, so that all those of you who are studying this because you're genuinely interested in company valuation rather than preparing for an exam can find it useful too. But this is just the way that it would be represented as a formula. And so we've got this cost of equity, we combine it with the cost that the company incurs in borrowing money, what we call the cost of debt, to give us what we call the weighted average cost of capital. And we can then apply that in this unquoted company to the annual earnings of the target company, and that would give us a valuation. It's a starting point. It's not perfect, but it starts us off. So I didn't say whack. It sounds like whack, but it needs a different type of superhero. So the weighted average cost of capital is you get how much the company's funds are based on equity, in other words, the shares, and the value of those shares on the stock market, and the value of the debt. We combine the two, and in this case, we've got a company with $1 million of investment, which is costing them 71,000 each year. So we're able to identify that it's carrying a 7.1% weighted average cost of capital. Now, we use this to work out the company value. So we're able to say earnings divided by the WACC would give us a company that's worth 250 million. It's this way of being able to take the earnings to give us a value for the company. So this is very much based on earnings approach. Now, I think it's worth it to think, well, why are we interested in buying a company? Very often we're interested in buying a company because we think that the earnings could grow. The people selling the company know that they're able to generate earnings of 17.75 million a year, so that they would probably not be willing to sell for 250 million. But if we, as the company, wanted to acquire that company, we may well say, well, we think that we can increase this annual return. And we would then need to adjust what we call the denominator on the fraction. So we're going to reduce the weighted average cost of capital by using the growth rate. So here, I've got two little questions for you. You don't have to answer them both, but I'd quite like you to have a little look at this. If we were expecting our growth to increase by 2.1%, and that the original weighted average cost of capital was 7.1%, can you work out what the adjusted percentage rate would be? Not quite, Sano. You've got the idea that it's going to be less. Let me try and help. It's a simple takeaway sum. Oh yes, thank you very much for trying. Now you get more marks because you tried than anybody else who didn't try. It's 5%. And the reason it's 5% is that we say 7.1% minus 2.1%. I think your sum was probably a little bit more sophisticated, but it's a straightforward takeaway sum. So by dividing our 17.75 million by 5%, the company value shoots up to 355 million. So if, as a predatory company, we were considering buying Sandy Inc. and we could see that the value of Sandy Inc. at the moment is 250 million based on the 17.75 million annual earnings and a weighted average cost of capital of 7.1%. But we considered that we had additional knowledge and additional ways of managing the business that we think would bring our cost of capital down. We would be able to increase our offer. The chances are that we wouldn't want to pay 355 million, but we would know that whatever we're buying would be worth 355 million. So we would be prepared to pay more than the 250 that we would consider to be its current value. So the earnings value approach, they tend to rely on projections of future profits or cash flows. And they also rely on finding a suitable rate as a weighted average cost of capital. So you can see that within the organization, if we get that wrong, we could end up spending an awful lot of money on a company that this isn't worth it. Or worse still, we could end up selling a company that's worth a lot more. Now we move on to the third, which is the market value approaches. These tend to be used by valuers of smaller companies, and it's an approach which is used where you look at similar businesses that have been sold recently, and you tend to use that business as a benchmark. And if you're selling the business, then you tell your prospective buyer that was the benchmark price of Handy Limited, and that you consider that this particular business has got so much more to offer, which would justify a higher price. And if you're the buyer, you tend to be saying, oh, well, I can see that Handy Limited sold for that price. Then if that's the case, then we consider that Sandy Incorporated isn't quite as good, so we would want to pay slightly less. And that would be the market value approach. So you're looking very much at a benchmark and then going above or below within the negotiation. So we've looked at 3 business valuation methods. Give me an opportunity to look at the chat box again, because I think I've seen something to do with industry beaters. Right. Co-Stoop has asked, while considering the industry, do betas vary depending on the size of the company? Um, if you're considering the industry beta, the business beta, rather than the company beta, then generally you would consider that that would be something which would be industry-wide. Um, it becomes rather academic because of the nature of businesses. So it does tend to have a slight difference between the real world and the world of accountancy students preparing for exams. I think if we were to look at this sort of academically, we might consider that perhaps the size of a business would mean that the beta should vary a little bit from the industry norm. But by and large, within the area that this is done in the real world, then the industry beta is taken as a broad point and is just left in that respect, irrespective of the size of the company. The gearing of the company, of course, then modifies that depending on whether it's a highly geared or lower geared company. Hope that helps. So this slide looks at the three business valuation methods, and we can see them, and we've just looked at them. Now, a couple of you have mentioned intangibles. I've already said that really, when you're looking at a earnings-based approach or looking at a market-based approach, intangibles are built into the cost of the organization, because the intangibles are there to generate the cash flows that enable the business to survive and to grow. So that's fine, but certainly there has been academic work on it, and when you're looking at an asset-based approach, then you'd quite like to add in intangibles, but you're often left wondering exactly how much they're worth. We know that they can't be included by financial accountants when they produce the financial reports, because they don't meet the accounting standards under any set of standards that I'm aware of anyway. Certainly the US GAAP, UK GAAP, or the international accounting standards don't allow very many intangibles. And very often the biggest and most important intangible is the sheer value of the workforce. And because they don't meet the control criteria within the conceptual framework for the international financial reporting standards, then they're not included within the financial reports. So how can we do this? If the asset-based approach would need to be modified, and so we would have generally an increase, and the earnings and market value approaches have basically built in the intangibles, because they're not doing a inputs-based approach. It's much more of an outputs-based approach. Well, can we identify a value for intangibles? Yes, I'm laughing because I've written, I suppose the answer is yes. I would certainly tell my accountancy students yes. Whether I would tell a business owner yes is a lot more debatable. I think it's a value that we can't absolutely be sure about, and I've written that here. We're not really sure that we can identify an accurate value for intangibles. Accountancy exams often test something that's called calculated intangible value, and in doing this, we would be doing a bit more benchmarking. So it brings us back to that market value approach that we were looking at a few minutes ago. And what we do is we say, okay, such and such a company in the same industry or an average in the industry generates a particular return. Our company generates a slightly higher return on the assets that it employs. And we would then say, okay, the reported assets in our company are giving the impression that we are having a higher return than the average for our industry. So we would modify it and we would say, let's compare and see what the return would be based on the industry average. So let's have a look. Method, we find a suitable competitor and we look at their return on assets. Operating profit divided by the assets employed. And if not, then we use the industry average. And then we produce something which we call the company's value spread. So let's look at the value spread. This is the return our company that has the intangibles achieves, which is over and above the return that our competitor achieves. So here we have it, company operating profit less what the industry is generally getting from the same company asset base gives us our value spread. It's our premium, the amount, the additional profit that we're generating. And then we make an assumption. We assume that this value spread would be earned into perpetuity. In other words, forever. And we adjust it for the post-tax value of the spread. And we would divide that by our cost of capital. And then we would add this calculated intangible value onto the net asset value, and that would give us an adjusted value of the firm. Now, I must give CIMA some praise. This particular method was a named method in their previous syllabus for the financial strategy paper. I think that they've recognised that it's a little bit contrived and that they no longer name it within their current financial strategy paper. Let's now look at something that's been happening recently, and this is the, well, I said it was 2.7 billion US dollars. The reports, of course, within the UK tend to use euros, so it's a 2.27 billion acquisition of Carver Korea by Lever in euros. And here we can look at evaluation. There's another recent valuation, was the acquisition of WhatsApp. WhatsApp was bought by Facebook, and WhatsApp used their valuation as being that they had $1 million for every user, so that they're able to come up with a value for their company which was entirely based on the number of people who were using WhatsApp. So it's a customer-based approach. Oh, sorry, $55 per user. My apologies. $55 per user, giving them a 16 billion valuation. And so that this is certainly the way that things are going. And I think, rather like the earlier slides, within the Unilever and Korea Carver aspect, that Unilever considered it was worth it to pay this price. And the owners of Korea Carbon, thought it was worth it to sell. And that's, of course, the basis for any transaction, isn't it? That if the person holding the asset considers it worth more than the person who wants to buy it, then they're not going to sell it. So it only tends to work as a sale if the seller considers that the offer that they've received is higher than the amount that they consider it's worth themselves. There isn't a syllabus when companies are bought and sold. So the prices can be incredibly rational and they can be irrational. And this is the real world. The real world doesn't succumb to examiners or anything else like that making up the rules. And prices can incorporate factors that are not included within any accountancy syllabi. I do think that the strategic case study for SEMA is probably one exam more than any other which does reflect real life. I think one of the biggest pluses is the fact that it doesn't make the candidates do an awful lot of sums. It's really looking at the understanding and so on. So could you say that 2.27 billion euros was the correct value of Carver? Well, the Unilever would say it was worth more, and Bain Capital and Goldman Sachs would say that it was high enough. So it starts with the accounting sums. I think the company valuation is very much that you need this foundation. They give an idea of the value today. They don't give you the transaction price, but they do tell you, depending on who you are. If you're the seller, it tells how much it's worth to you. If you're the buyer, it tells how much it would be worth to you. And it's the fact that the buyer perceives the higher value than the seller, which will lead to the sale. And Carver Korea revenue was 321 million, almost 3 times the value in 2015. So it has gone up. But Unilever paid about 7 times the revenue. That's before you've taken into consideration any other expenses and costs. So it looks high. But Mintel work has shown that the South Korea beauty market, which is where they sell by far the largest proportion of their beauty products, is $13 billion. And half of that, more than half of that, is in facial skincare. And Korea Carver is the 3rd largest cosmetics company in Korea. And they're selling into China. So we've got opportunities here for Unilever that perhaps didn't exist for the Korea Carver company. So using the Unilever sales network, these products can get out further into the world. And by using the Korea Carver network, Unilever has a way of getting into the South Korea beauty market. So that you've got these 2 additional factors that would have been in the minds of the valuers. And the key to the price would lie in the future cash flows. They can see growth that the previous owners couldn't see. They are looking at synergy. Synergy, this idea of 1 + 1 is greater than 2. And a future which includes synergy has a higher present value of the future cash flows that will be higher than a future without synergy. And it enables the buyer to value the company higher than the value that the seller attributes to it. So we've been looking at how to value a company. My name's Sandy Hood. I haven't given you an awful lot of chance to get involved, but here's a little summing up. we've looked at why we would want to find a value. We've recognised that future cash flows is basically the value, but that we don't know. We can't go into the future and then come back and buy the company. So we don't know what it is. So we have to approximate, and we use various other methods. We looked at asset-based. We then even brought that forward to those intangible assets that are not reported. And we also looked at earnings and market value based. Then we came round to talk about two valuations recently, WhatsApp and Carver Korea, and we recognised the significance of synergy. So here, Carver Korea, beauty is in the eye of the beholder, an expression attributed to the famous Chinese philosopher Confucius. And I think we can say that company value, the price at which a willing seller will sell and a willing buyer will buy, is similarly in the view of the people involved. So beauty and valuation in the eye of the beholder. So I've pretty much come up to 12 o'clock Dubai time, and if you're in Brisbane, 6 o'clock in the evening Brisbane time. Let's see if you've got any little last questions for me. Well, Coach 2 has asked me, can you please discuss how businesses are valued when one business is taking over for more market share in other markets, maybe international markets? I'm not sure when that came up, because of course that's exactly what Unilever have done. Unilever didn't have much presence in that part of the Asian market. They were valuing the business as a conduit, as a way of being able to get in and enjoy the benefits of this 13 billion market of 13 billion market in South Korea, and also to give them access into some of the other markets that Carver Korea also have. So they came with this value of 7 times revenue, which in my opinion looks high. I think time will tell whether they've got it right or not. I don't think I'm alone in being a little bit cautious about this particular acquisition, but they would have done it because they were able to look at Carver. They were able to look at the market growth within South Korea, and they were able to look at the synergies that they would be able to generate, both by being able to sell Carver Korea products within their own existing markets, and also the opportunity that they might be able to gain some additional market sales by selling Unilever's existing products using the network that Carver Korea have over there. I hope that that's helpful enough. Thank you. Okay, that's good. Any other questions or comments? I think we've probably got 2 or 3 minutes. How will an unquoted company be valued if they don't have much of fixed assets comparing a similar business? Yes. In an accountancy exam, Shannon, you'd be somehow whisked away to a private. Yes, of course I can, Kesha. But yeah, so going back to Sano's question about the unquoted company, if they don't have a lot of fixed assets, well, you would be using an earnings-based approach primarily, because you wouldn't be able to use the fixed assets because there aren't any, and they are primarily based on the skills of the workforce, and this is widely done within service industries. And yes, you can compare with similar businesses in the same industry, and that's generally what's been happening, certainly with a lot of these internet companies, that when they've been looking for valuations, because they're not quoted, they've been looking across at similar other companies to benchmark the starting point, and then either increase or decrease based on that. Well, thank you all very much. I know there's been quite a few of you. Let me just see how many people are still here. And we've got 18, I think, at this stage, plus myself and Andrew. I hope you found it interesting.
Thanks, Sandy.
You're most welcome.
And this is a very interesting topic because we looked at beauty and valuation, two things that you at times think don't come together, and it certainly does in this case. I want to give an example of MBF, an Australian. It was Australia's biggest insurance company, MBF. About 6 to 7 years ago, Bupa UK acquired MBF, and MBF was about to go into stock exchange listing. It was a mutual company, but Bupa saw the potential to get into the Australian New Zealand market and paid a significant value to acquire this company to the members. It was a mutual company. So the members opted to go with Bupa and not to list in the stock exchange. Very interesting case study about something that happened about 6-7 years ago. So, and Sandy, it is exactly like you said, beauty is in the eye of the beholder. And today that has been a very successful venture, and Bupa is very much present in Australia and New Zealand in a big way.
Yes. And it gave them that entrance into the market, didn't it?
Correct,
yeah.
Correct, it did. So this webinar is going to get posted on YouTube as well, because there were many students, members who were interested. Over 100 participants had registered. For some reason, they've not been able to log in today, but it will be posted on YouTube and other social media as well. And we will certainly share with you the presentation slides. And just to let everyone know that we will be running the CIMA strategic case study classes, as well as our the management case study classes. And we are also promoting a new program. Sandy is going to be one of our star lecturers there. That's the postgraduate diploma course. Thanks all for joining. Thank you so much, Sandy. It was really interesting.
Well, thank you to everybody, and thank you, Andrew, very much. I thoroughly enjoyed it.